All right, let's jump right in. We're going to tackle a real-world financial mystery, one that honestly baffled a lot of people, because on the surface, it just doesn't add up.
So here's the puzzle at the heart of it all. You've got Silicon Valley Bank, a major player, right? They go out and buy billions of dollars worth of what's supposed to be the safest investment in the world, U.S. government bonds. And what happens next? They go bankrupt. It's wild. How is that even possible? I mean, how can holding something that's basically a government-backed IOU cause a huge bank to just collapse?
Okay, so to get to the bottom of this, we've got to challenge something we think we know. Most of us, when we hear bonds, we think boring, right? Like a fixed-term deposit at a bank. You put your money in, you get it back with some interest. Super safe, super stable. But here's the twist. That's not the whole story. The reality is, once a bond is out there in the market, its price is changing every single day. Yeah, just like a stock.
And that brings us to our first huge clue. You got to remember this one. It's like the golden rule of bond investing. Think of a seesaw. On one side, you have interest rates, or yield, as it's called. On the other side, you have the bond's price. When interest rates go up, the price of bonds already out there goes down. They move in opposite directions, just like a seesaw. And believe me, understanding this dynamic is everything.
You know, the best way to really get this is to change how you think about it. Forget interest rate for a second and think discount rate. A bond is just a promise to pay you a fixed chunk of cash in the future, right? So the interest rate is basically the discount you get for buying that future promise today. It's just like shopping. A 30% off coupon gets you a lower price than a 10% off coupon. Same exact thing here. A higher interest rate is just a bigger discount. And a bigger discount means you pay a lower price for that bond.
And if you want to see the math, here it is. But hey, don't worry, no pop quiz, I promise. Just look at the formula. See that little r for the interest rate? It's in the denominator, the bottom part of the fraction. And if you remember from school, whenever you make the bottom number of a fraction bigger, the whole thing gets smaller. That's literally all it is. As r goes up, the price, p, has to go down.
Okay, so we've got the seesaw down, but that's only part of the puzzle. Here's where it gets really interesting. Not all bonds react the same way to those interest rate swings. Some get rocked way harder than others, and that brings us to our second crucial clue. So this second clue has a name: duration. And honestly, duration is just a fancy word for risk. It's a number that tells you how sensitive a bond's price is to a change in interest rates. So if a bond has a duration of, say, 8, it means its price is going to drop by about 8% if interest rates go up by just 1%. The higher the duration, the bigger the price swing, and yep, the bigger the risk.
So you're probably thinking, why on earth would a bank take on all that extra risk? Well, it all comes down to temptation. We're talking about the yield curve. It's pretty simple, actually. If you lend a friend money for a week, you might not ask for much interest. But what if you lent it to them for 20 years? You'd want a lot more in return for tying up your money for so long, right? Bonds work the exact same way. Long-term bonds, the ones with that high duration we talked about, almost always pay you a higher interest rate. And for a bank like SVB, looking to make a profit, that extra yield was just too tempting to pass up.
And look at this. This chart shows you that risk in plain sight. We have the exact same 1% rate hike hitting two different bonds. The short duration one, its price drops about 4.5%. Not great, but manageable. But the long duration bond, whoa, its price tanks by over 8%. That's nearly double the drop. It's just so much more sensitive. And that is the hidden danger of chasing after those higher yields.
All right, with those two clues, the interest rate seesaw and duration, we can finally put the whole story together. Here's how it went down. Step 1. SVB is flush with cash from its customers, short-term deposits. Step 2. What do they do with it? They invest it in long-term, high-duration bonds to squeeze out more profit. Step 3. The U.S. Federal Reserve starts hiking interest rates like there's no tomorrow. And then the final domino falls. Step 4. The market value of all those long-term bonds SVB was holding, it completely cratered.
And here it is, the fatal blow. See, if SVB could have just sat tight and held those bonds to the very end, they would have gotten all their money back. They would have been fine. But they couldn't. Their customers started getting nervous and pulling their deposits out. So the bank had to sell those bonds to get cash. They became what's called a forced seller, having to dump their assets at the worst possible moment, right after the prices crashed. And that's how they turned paper losses into billions of dollars of very, very real losses.
So, why are we digging all this up? Because the story of SVB isn't just some dusty old case study. It is an incredibly important lesson for you, for me, for every single investor trying to navigate the market right now.
And the reason it matters so much is right here. Interest rates went from basically 0 to over 5% in one of the fastest hiking sprees we've ever seen. The exact same environment, the same powerful force that sank a major bank, well, that's the world we're all investing in today. You have to be aware of it.
So, what's a regular person supposed to do about all this? I mean, buying individual bonds can be complicated, and you need a lot of money. But thankfully, there's a really simple solution. Bond ETFs. ETFs are exchange-traded funds. Basically, they let you buy a whole bucket of hundreds of different bonds all at once, with just one click. It's an easy way to get instant diversification.
And the cool thing is, you have a ton of options. Just look at this table. Whether you just want to park some cash for a few months and keep it safe in an ultra-short-term fund, or you're investing for retirement 30 years from now, there's an ETF designed for that. You can literally pick the exact timeline and risk level that fits what you need.
Okay, this brings us to the real takeaway, the single most important part of this whole thing. How do you take the lesson from SVB's massive failure and actually apply it to your own money? So, what was SVB's big mistake? It's something called an asset-liability mismatch. Sounds technical, but it's simple. Their liabilities, the money they might have to pay back quickly, were short-term, but their assets, their investments, were all tied up for the long term. You can completely avoid that trap by just thinking about your own assets and liabilities. And here's the trick. Your liabilities are just your financial goals. Need money for a down payment in 2 years? That's a 2-year liability. Planning for retirement in 30 years? That's a 30-year liability. See?
So the strategy becomes incredibly simple. All you have to do is match your investment's duration to your goal's timeline. If you need that house down payment in 2 years, you put it in a short-duration bond ETF to keep it safe. But for a long-term goal like retirement, you can afford to take on more duration risk, maybe get some higher returns because you've got decades to let it grow and ride out any bumps in the road. The whole point, the golden rule, is to set yourself up so you never have to sell at the wrong time.
So when we put it all together, we see that bonds aren't just safe or risky. That's the wrong way to look at it. They're a tool, a really powerful tool for managing risk and hitting your financial goals. Ultimately, the question isn't about the bond. It's about you, the investor. It's about being smart and deliberately choosing the right kind of risk for the right amount of time to build the future you're aiming for.